we had the worst absolute performance of my tenure, and compared to the S&P, the worst relative performance as well. Relative results are what concern us. Over time, bad relative numbers will produce unsatisfactory absolute returns. And then he had, my one subject is capital allocation, and my grade for 1999, most assuredly, it's a D. So he basically, crucifixed himself at the very beginning of the letter.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome to this new IBKR podcast. This is your host here, Guillaume Roux-Chabert from Interactive Brokers Singapore. I am joined for the second time by Stefano Grasso, portfolio manager for the Enhanced Value Fund in Singapore. And our topic today is a follow-up of our first podcast about value investing that we released on the 19th of May, which I recommend. So for this second episode, we will drill down further on value investing and get Stefano's portfolio manager's perspective. What's so special about Warren Buffett? Stefano, welcome back.
Thank you. Thanks for having me.
It's a pleasure. All right, so maybe we can start from, actually, you have quite a story here. We can start from your first encounter with Warren Buffett himself. When was that and how did it go?
So I physically met Warren Buffett in 2013 in Omaha for one of the annual meetings that I attended in person. And the meeting was very brief, but it pushed me to ask him a question at the following annual meeting. And the question was regarding the leverage level for Berkshire Hathaway. So my point was basically giving, the transition that Berkshire at some point will go through from new management, future management. My question was, why don't they increase the leverage and basically leave as a task for the next management to just delever the balance sheet? A much easier task than find very good investments, a much straightforward job to do. And when I asked this question, I got both Warren Buffett and Charlie Munger to answer. And, they basically, in essence, they said, what you're saying makes sense, is good, but we're very conservative and probably we're not going to do that. Anyway, the meeting goes by and usually there is a session in the morning, which is when I ask the question, and a break, and then a session in the afternoon. And it's all, Q&A, so 3 hours in the morning and a few hours in the afternoon. So when we come back after lunch, Warren Buffett turned to Charlie Munger and asked him, what do you think about this morning session? And Charlie Munger says, whatever, fine, as usual, and asked Warren Buffett back, and for you, how was it? And Buffett says, I really like the question of the Italian fellow. And so, we heard that because the mic were on before the second session started. So I gave a hard time for the rest of the trip to my friends, saying, there were no other Italian fellows, so it was me. So that was fun.
Excellent. That's a great story. Okay, so I guess since then you mentioned you've been constantly following Buffett's moves. Could you elaborate on what move you followed and what worked and what lesson did you learn? And did you also integrate this leverage point of view in your strategies?
Yeah, so I think, it got really intense for me, my exposure to Warren Buffett. After the first meeting I attended, I set up a daily email alert with Google. So every day I have been receiving a sort of, collection of all the news of Berkshire Hathaway and Warren Buffett. And when I was in the US, I was getting these in the morning. And then I moved to London. And then, I went in Tanzania. And for the last few years, I was in Singapore. So different time zone. But that email hit me. Now is, a different time of the day. I have been reading everything I could put my hands on, for a period of probably, I think for the first 8 years, I never skipped a day, holiday, traveling, whatever. I always read everything to a point that I think I really got in sync with their thinking and the Berkshire Hathaway. I mean, many times I see some events, then I read the headlines and I say, no, guys, you didn't get it. I mean, he's meaning something different, right? So it's has been a journey that, without even meeting personally, without talking with Warren Buffett, I kind of followed him. And I apply to the extent that is possible many of his strategies, thinking to my day-to-day job at Enhanced Value Fund, with of course the difference in size, and the man is the man, but still a good push to do its best.
Yeah, I mean, I guess, having like this kind of exposure helps you to synchronize with his thought process. And he always mentioned about the trading as an intellectual process, intellectual thought process first. And so beyond the emails that you mentioned and the exposure that you have with the automated alerts, you mentioned also you attach quite a particular importance to the famous Warren Buffett's annual letter to shareholder. And by the way, we will put the link in the podcast script for the audience. And I think you've selected a few letters. So shall we start maybe with the first one, as it defines Warren Buffett's initial trading philosophy, which was written back in 1977, if I'm not wrong.
Correct, yes. And, I think both the letter and the transcript and the recording of the annual meeting are really the best way to get the unfiltered Warren Buffett thinking. He really tries to put this in his words, to speak to, he says, his sister, so non-finance background person, and explain the very complex development as it is, 1 year of a conglomerate development with multiple different businesses and sectors in very simple words and in plain English. And in the first letter, I think, I suggest the letters are few pages, from really single digit to maybe 20 pages or so, very short. And they cross from 77. So they go through, crisis, inflation, high interest rates, low interest rates. It's really a journey and a reflection year over year over our times, or over our economy. And the first letter laid out few concepts that then are picked up again and again. And in the 77, he starts making a distinction on how to report earnings. And he's saying, basically, I could write to you that our operating earnings were up 37% from the year before. But this wouldn't be fair, because our beginning capital was also up 24%. So if I just compare, what he was saying is, if I just compare operating earnings, I say I'm 37% up, but I'm using more capital. So I need to factor that in. So he says, that's why I'm reporting that our operating earnings on beginning equity capital amounted to 19%, slightly better than last year and above our long-term average. But still, he started laying out how he would like to, kind of read of financial information in a standard way that is basically taking out the noise from the growth and other things. He basically say, most companies define record earnings when there is a new high, but that means very little if you have retained earnings, because it's the same that, he's saying, actually, after all, even a totally dormant saving account will produce steadily rising interest earnings each year, just because of the compounding, because you invest 100, next year is 105. If you make 5%, and then, the 5% is going to apply to 105. So it's going to be higher and higher and so on. So he's basically saying, I don't want to take credit for that, and I'm reporting you in this very straightforward way. And another point that come up in this very first letter is a concept that has been driving his investment strategy and career since the very beginning, but consistently throughout, is that he says, we prefer to invest. One lesson that he learned is the importance of being in businesses where tailwinds prevail rather than headwinds. I mean, another famous quote, not in this letter, is, they say that they invested in Coke because Coke is such a great business that even an idiot could run it. So the point is, I want to be in businesses that have so strong economics that I don't need to worry about if for a few years there is not the best guy running it. So this is something that already came out. And, this is 77. He's a young man. And, it's very remarkable how few things that laid out there have been like, he would say them in the same way, after 50 plus years. And lastly, he mentioned Seas Candy. And Seas Candy had at the time operating pre-tax operating earnings of about 10 million. And of course, now the business has grown, has probably worth several billions. And this is a company that makes candies and is located in the West Coast, the US, and have been taught in business school as a kind of remarkable business that was very quick to pay back to the shareholder the purchase price and then kept giving dividends year in, year out and providing a very good return. So these are the three things that I would highlight about the 77 letter.
Yeah, that was in 1977, and we could tell he was already quite making sure not to oversell, which is quite unique when you read annual statement in general, I have to say. So moving on to another very important letter is the 1999 letter, as this year he underperformed the S&P 500, and he was quite upfront about it, right? So you told me it tells a lot about the person itself. Could you give us more insights and content on this 1999 letter?
Yeah, so to put things in perspective, I mean, Berkshire had already quite a long track record. So the confidence in the business definitely there. However, has been a couple of interesting years for Berkshire Hathaway because the letter is the 99 letter that was published in February or early March 2020, which was really the middle of the dot-com bubble. And as it periodically happened, when there are bubbles, call it the crypto bubble, everyone is talking, taking the cap about, Bitcoin and Ethereum and things. And basically the old-fashioned investment kind of are less interesting, less sexy, and money get out to go where hot money are. And in the dot-com bubble, during the dot-com bubble, the Berkshire portfolio was very much missing that unstoppable rising of the part of the market, the Nasdaq, let's call it. So in 99, the increase in book value per share, that was the yardstick that Buffett used for many years, increased only 0.5%, whereby the S&P increased 21%. And the share price of Berkshire Hathaway decreased about 20%. So there was basically a 40% underperformance in 1 year. That is something that is unheard of. When you manage money, you never want to report underperformance. They have been always very clear what the yardstick were, the benchmark, and so that was up there. But you might want to say, hey, just a year is going to reverse back. Don't worry. He was so plain in admitting the underperformance, the facts. He starts saying the numbers on the facing page show just how poor our 99 record was. We had the worst absolute performance of my tenure, and compared to the S&P, the worst relative performance as well. Relative results are what concern us. Over time, bad relative numbers will produce unsatisfactory absolute returns. And then he had, my one subject is capital allocation. And my grade for 1999, most assuredly, it's a D. So he basically, crucifixes himself at the very beginning of the letter and says, this is what didn't work. These are the businesses. They had also, the problem were compounded by a reinsurance business that they bought that had underwriting losses. And there was also a bit of, noise. But when the letter was written, Berkshire Hathaway was at the bottom, what turned out to be the top for the market and the bottom for the stock Berkshire Hathaway. And the funny thing was that concluding the letter, he has a message of optimism and says, we believe this is not reflecting the true earning power of our company. And we are almost certainly that the S&P will do far less well in the next decade than it has done since the previous decade. And of course, then you can check 10 years after this letter was written, the S&P was down. Maybe if you include the dividends, was more or less right. So you have a guy that is in extreme under pressure that says, this is what it's happening in a very transparent way. And then says, but by the way, I think, the next decade, which is not a quarter prediction, I don't see how this system can sustain itself at this rate has increased. And guess what? Of course, the S&P was flat and Berkshire was like 2x or so in terms of capital appreciation. So I think it's for aspiring money manager, for people that are interested in investing, being truth to oneself and just saying, just being factual about what's happening is a big thing to keep in mind.
Yes, absolutely. And maybe one last letter that reflects what you mentioned, but a little bit more like on a technical point. That's always very interesting. So that's the 2018 letter. It is another turning point because Warren Buffett decided to shift from a per share book value to a share price. So if you could explain a bit the difference and why was that a better measurement of business performance?
Yeah, so it's a turning point, and he has always been very ruthless about the market participants that change the yardstick. So he hates when managers change the strike price of the stock option for the management team. He hates when there are change in benchmark in investments because, he says people are doing tricks. So it was quite remarkable to see him finally giving in what was a measure that was not representative anymore of the value of Berkshire. He started using book value when the majority of the Berkshire Hathaway were listed company invested. Stocks and observable numbers. So it's very easy to calculate the market price. If you own a stock which is worth 100, your book value is 100. But the problem with time came because of a combination of two things. One, Berkshire started buying bigger and bigger, more and more, private companies. And therefore, there was a shift between what is traded and visible and what is the book value, so the acquisition price kind of the business. And these businesses, you don't mark up, you only mark down if there is an impairment. But, in the example of See's Candy, probably they have on the book for few million that they paid, and the business now is worth a multiple of that. But when you look at Berkshire book value, you don't see that example, and you don't see that transformation of the business. And so this shift between listed and private business is making the book value less and less relevant. And the second thing is an accounting rule, I think is from the 70s in the US. When you buy a business, you often book a part of the purchase price as a goodwill. So it's the difference between what are the hard assets of the company and the premium that as a buyer you pay to get ownership of the business. And the accounting rule wants to force you to write down this accounting goodwill, I think, over a period of 30 or 40 years. So basically, the longer you keep this business, the lower the book value, the more the book value is reduced. And, companies like Geico, the insurance, if you look at Geico number when they took it private, they had the market share was like single digit in the United States, and the revenues were a fraction of what they are today. So the business clearly it's worth tens of billions now, but the purchase value not only hasn't increased, but has been reduced by the amortization of the goodwill. So in 2018, he kind of gave in and said, look, it's not meaningful to report this number, and it's not really a fair comparison with the S&P 500. So let's switch to the share price, which is more volatile. That's why he didn't choose it before. But he says it's more reflective of the true value of Berkshire Hathaway, of the intrinsic value of Berkshire Hathaway. And I think the 2018 letter in general is one of the last one where he goes into certain level of details of, explaining certain concepts. So it's another good one that I thought about flagging for reading.
Okay, excellent. Yeah, it's quite a change indeed, because I think he mentioned that he wished he could not see the price of a share when he value a company, just not to be influenced by if it's interesting or not to buy, and he wanted to have it just like an intellectual process. So that's indeed a shift of thought for him, even though he keeps on, of course, his value investing. So moving forward, I'd like to ask you actually, what is for you the future of value investing, and do you think it's threatened by high frequency trading or liquidity crush or any other thing?
I mean, recently we read about this ChatGPT fund that is basically, run by ChatGPT, where they ask which stock to put in a portfolio and they're tracking it. For the first few days, the news was that overperforming the S&P. But I think in terms of AI, maybe certain strategy will be probably interesting. to implement. But for high frequency trading and liquidity, I think it's actually an advantage. There are certain funds. An example is, we currently see the recession fear and certain commodity being sold, and basically a lot of momentum funds going after this trend and following the trend. If you are a patient investor and you have an investment thesis that is correct, you basically have willing and heavy sellers that are going to sell you assets that you see as undervalued. So if your time horizon is not like a week or a month or a quarter, but you think that the asset is undervalued for the next 3-5 years, then is when you can flip into an opportunity and really take advantage of that. So I'm positive on actually the impact of the high frequency and the liquidity on value investing.
Understood. Okay, well, we arrive at the end of podcast today. So thank you very much, Stefano, from the Enhanced Value Fund in Singapore. That was a great insight about Warren Buffett, and I hope it will entice our audience to read these shareholder letters that are really interesting. Thanks all for listening. And to know more about Stefano, please refer to the link. We're going to put it in the description. Thanks, Stefano.
Thank you, Guillaume.
Thanks for listening to Traders Insight Radio. As always, there's more content at tradersinsight.news. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education materials such as webinars at ibkrwebinars.com, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.